Welcome to Inevitable Wealth from Liberty One Wealth Advisors, a conversation around financial decision making and events around the globe. In the age of instant information, level heads can be hard to find. Our hosts, Julian DiLeonardo and Jacky Petit-Homme, provide objective and relevant insights to help you parse the data and block out the noise as you build your wealth. As managing partners of Liberty One Wealth Advisors, Julian and Jacky look to empower you to develop an increased understanding of financial markets and how they impact you.
Hello. Good morning, everyone. Welcome to our 8th episode of Inevitable Wealth. As always, we're looking to clear the air around complex topics and sometimes misleading headlines that we all come across in our everyday lives. If this is your first time listening, my name is Jacky Petit-Homme, and I am here with my host, Julian DiLeonardo. Julian, how are you this morning?
I'm good. Thanks for joining us, everyone.
Awesome. So today we're tackling a big question in the investment world. So if you've been paying attention in any bit, right, the markets have been doing pretty well the last couple months into 2024 here and hitting new highs. And often folks who might have some cash to invest or they want to invest might ask themselves a question, or others, hey, how should I invest when the market is at all-time highs, excuse me. So there are a few different components, right? Investment selection and the timing. And we're going to break down each piece, hopefully as concise as possible. So, we're not talking at you all morning here, but let's start with the timing. Julian, do you want to take that one?
Absolutely. So there are two main components or two main ways to go about it, right? There's dollar cost averaging and lump sum. Now, dollar cost averaging is putting in a specific amount over a set timeline repeatedly, right? So if we have some folks, they sell their house, they have $600,000. So they might do $50,000 a month on the first of the month, every month for the next year. Or option two, lump sum, right? So we have $600,000. The market opens in 34 minutes. We go in, we buy today, right? With the full boat. Now, two different options. We can talk about the statistics and what makes sense. But I'll lead with, and I say this often, the best diet is the one you stick to, right? Because number one is having those funds invested for the long term, not panicking. There's going to be ebbs and flows regardless of which option you choose. So it can be a really great opportunity to build your wealth over time regardless.
Yeah. And, Julian, you say these large numbers, right? Some folks, they might have proceeds from a home sale or real estate. That's hundreds of thousands of dollars. Or even we've come across families that have, 7 figures in cash, right? Because they haven't had professional help. And if you don't know what you're doing, it can be daunting, right? That's a big sum of money and you want to do it correctly, right? So let's talk first about the dollar cost averaging, right? The dollar cost averaging just basically is that regular interval investing. So what would you say is the main advantage of the dollar cost averaging? Is that something, or I guess I would say, what type of demographic of a investor would benefit from a dollar cost averaging approach?
So for the most part, I would say it's for folks who are a little bit more nervous about taking that step. Because if you do have, I keep saying $600,000 to invest in the market, $50,000 a month for 12 months is reasonable to do in the sense that it's going to have less market volatility. Because for the first 2 months, you only have $100,000 invested, then 150, then 200. So if there's a pullback, it impacts you significantly less than, say, putting in the full 600,000. Now, on the flip side, you're not receiving the growth that you would if you invested 600,000 either. But it can reduce the overall market volatility. You are buying more shares when the cost of the share is cheaper. So for example, if you are buying a stock at $100 and it goes to 80 and you're still putting in that $50,000, you're going to be able to accumulate more shares than you would if it's at 120 or 100. So that can be really beneficial, where psychologically you are more comfortable with the set it and forget it approach. You have the opportunity to buy more shares cheaper should there be a pullback, and you're able to withstand that volatility over time. Jacky, is there anything you would add there?
Yeah, and yeah, I would say, there's everything has the downside and the upside, right? And I would say that the biggest thing for dollar cost averaging is that qualitative peace of mind. Um, and sometimes if you time it out perfectly, and you might take advantage of some pullbacks or corrections, so those dollars get more purchasing power. Um, However, sometimes there is the downside where holding that cash and waiting to invest could mean losing those potential gains, right? I'm not too sure. I don't recall the exact statistic, but the market is more often rising than it is pulling back. So sometimes if you are dollar cost averaging, you're purchasing into a rising market. So at the end of the day, if you're investing long term, right, 5, 10, 20, 30 years plus, those little nuances in the market volatility won't impact you greatly, but that's just something to remember if you do start the dollar cost averaging uh, process investing strategy. So let's jump over to lump sum investing, right? So essentially the lump sum is saying, yep, I've got this cash, and like Julian just mentioned, the market opens in 30 minutes and we're just going to dump it all into our well diversified investment strategy. So Julian, what would you say is, I guess, the pros and cons of the lump sum investing?
So pros and cons, lump sum investing. Number one, right? You do it in one day, maybe a week, whatever it may be, and then it's done, right? You don't have to go back in and do it, right? Less friction in your day-to-day life going about this, right? Great, knock it out. Two, most important in our view, lump sum investing historically has outperformed dollar cost averaging. And the logic behind that is really simple. So if the market historically has done, 7 to 10% a year, if you put that all in on the first of the year versus the last of the year, the first of the year you get that 7 to 10%. The last day of the year you do not. Now that's assuming straight line growth, which you don't always see, and we talked about volatility. But lump sum investing outperforms dollar cost averaging historically about 68% of the time, as of the latest literature we've looked at. So something to note where you see that. As far as cons, of course, more volatility, right? If you are unlucky as far as timing, you may see a pullback, right, briefly after putting the funds in, right? And that's always unfortunate. It's part of, it's the cost of admission of being invested is volatility. So it's something where once you put it in, regardless of whether you're dollar cost averaging or lump sum, you can't look backwards, right? I say to a lot of folks, and I just said it to my sister the other day, investing is not a test where somebody gets 100% on, right? We're looking to get an A, but you are, roughly never, right, going to nail it where you are buying at the exact bottom with all of the funds that you just received through inheritance or selling your home or whatever it may be. And that's right when you get the funds and you get to buy, right? The timing never works out perfectly. Jacky, what would you add to that?
That's exactly what I was going to say from at least a qualitative standpoint. Some folks have done it and it was just sheer luck, right? They say, hey, I've got this money, I'm going to put in the market. And the market did well over the course of the next few months or even years. And I always tell folks, hey, don't let this give you false confidence, right? If you put money in the market and it timed out well, worked out well, great, I'm happy for you, but don't think that you've become a whiz kid, right? And time the market. So of course, the timing is is tough and difficult, but we always want to remember whatever we are investing is long term. So even if you put money in today and the market sells off, there's a correction, it pulls back 5%, what have you, right? That's okay because you're in it for the long term. So know the risks, but understand that we're in this for the long term, and there's going to be that intraday, intramonth, intra-year pullbacks. So yeah, so I think we've kind of circled that one, and let's jump over to what I like to say the middle of the road, right? So sometimes when we have this lump sum or the dollar cost average, it becomes a little bit more of art, not a science, right? Depending on the families that we serve. So, Jill, would you like to touch on, and I think you've done this pretty recently with the new family, of kind of doing a little bit of both strategies?
Mm-hmm. Yeah, so I think it's one of the more comfortable ways to go about it is a hybrid. So you look at it and you say, we're going to do 50,000 a month for the next year. If we see an opportunity, right, we are going to take advantage of that. So when the market pulled back last year 20%, we're able to say, hey, let's put in 300,000 now, right, of your investment, and then if it falls further, we will do the final 200, right, assuming we're 2 months in, so they already have 100 in. So really finding a hybrid option where you have optionality over a portion of it, which is typically, right, how a lot of folks go about it. It's important to note that when you look at investing at all-time highs, roughly 30% of the time over the past 80 years or so, the all-time high acts as a floor. So there is always this nervousness about investing at an all-time high, but about 29.9% of the time, you see that all-time high act as a market floor. So it's actually the best time to invest 30% of the time, or has been historically, going forward.
Yeah, that's a good point as well, because same thing, we meet families that have cash from some sort of proceed, or even they got spooked at some point in the past, went to cash, and now they're afraid to get back in because you end up doing this hopscotch. Once you're out and you're trying to time the market, there's always going to be a reason mentally or headline wise why you're going to convince yourself why not to get back in, right?
Exactly. And when you turn on CNBC, which I don't recommend watching, but they always talk about all-time highs as ominous, right? It's always like, "Ooh, we're at all-time highs, watch out because it can only go down from here." But what I've seen is statistically 6.6% of the time, 6.6% of days that the market closes, the S&P is at new all-time highs, right? So 1 out of every 20, roughly, historically speaking. But that's a lot, right? I don't think I'm wrong there. But that's a lot of days. So it's something where it always feels, at least when you're watching things like that, they try and make it feel ominous, but it can be a great opportunity. And in my view, what's going to come after an all-time high is another all-time high, and it might be 10 days away. It might be a year away. But that's why we invest, is to get to that next all-time high going forward.
Yeah. And that's one thing I always hear a phrase which kind of bothers me. I don't know if it bothers you, but I always see it. From everyone, investment professionals, people on social media, say, "Oh, the old saying, what goes up must come down." I'm like, you're talking about gravity. You're not. Yes, the market goes up and down, but just because something's an all-time high doesn't mean we're rounding the corner of some, life-changing sell-off, right? We're gonna have those moments, but just because we're hitting that all-time high, it isn't a warning signal. Because most cases they're referencing the S&P 500 index, and if you're not aware what that is, right, that's basically the largest 500 U.S. companies. So they're typically great companies, and that index, right, is something that you should continue to invest in. But however, there are other companies in the world that are not in the U.S. alone, and then there are also more companies that are in the U.S. that are outside that index. So I also wanted to talk about that as well, because folks, right, people talk about the S&P, the Dow, the NASDAQ, right? So Jordan, can you actually talk a little bit about the cycle of like international stocks and just helping everyone think broader when they're looking at the investment landscape?
Absolutely. So when you turn on CNBC, which again, probably shouldn't, they talk about all-time highs, and all-time highs in that case, they're referencing the S&P 500. So the largest 500 stocks in the US, like Johnson & Johnson, ExxonMobil, Tesla, right? You've heard these companies before. They are strong companies, strong balance sheets, great, big fans of them. But when you go about investing, diversification is very important, right? Don't put all your eggs in one basket type of thing. So in our view, even when you're buying at all-time highs, you also, if you're investing with our team, are investing internationally. You're investing in small cap companies, mid cap companies, companies like Hilton or AutoZone, Palantir, right? Real estate investment trusts, international stocks like Toyota, I referenced. So you're looking at these different stocks, and when you are buying international, for example, over the past decade or so, international has lagged United States stocks, right? So their valuations are lower than United States S&P 500 stocks. So that can be a good opportunity when you look at dollar cost averaging or lump sum to buy in at these multiples that can be argued are more reasonable. Now, again, you don't want to put all your eggs into that basket either, but you see this cyclicality. Is that the right word? Between where for a decade, Europe and international stocks outperform the U.S., and then you see the U.S. over the past decade has significantly outperformed international, and at some point that comes back around. You do see a cyclical component to investing, whether it's value stocks versus growth, international versus U.S. But these are all great opportunities to continue to buy into the breadth of the market, right? Looking bigger than just buying NVIDIA, which, as fun as it's been, is not the answer.
Yeah, and that's a good point. When you're looking at investing, right, there's always going to be something in your portfolio that is underperforming, and that is the sign of a well-diversified portfolio, because everything is up. That means when things are down, everything is going to be down. So having that, you should be diversified stock-wise, right? You don't want to have all your eggs in one stock, but you also be diversified geographically, right? United States, is not the only country that has good companies. So Julian, I think we kind of, hit all the pieces here. Would you agree? Is there anything you think we should add before we wrap up?
When looking at it, so much of this, the best time to plant a tree was 20 years ago. Second best time is today, right? So when you do buy in, you stay the course, you invest in a diversified manner, and you look to, continue to grow with the market. Investing is a soft skill, not a hard science, and you want to continue to grow with it from a personal standpoint, an emotional standpoint, and look to grow from the long term.
Nice. Well done. Yeah. So listen, no strategy is one size fits all, right? It's about what works best for your unique financial position and your financial plan. Thank you all for listening. We're going to keep it brief, try to keep it good timing here. Of course, if there's anything you'd like us to discuss or anything we can do to, improve the podcast here, please don't hesitate to reach out. Again, I'm Jacky Petit-Homme, and I'm here with Julian DiLeonardo, and thank you all for listening. Take care.
Liberty One Wealth Advisors is a registered investment advisory firm located in the state of Pennsylvania. Any options expressed are derived from sources generally believed to be reliable and are provided for informational purposes only. It does not constitute any form of advice or recommendation to buy or sell any securities, adopt any investment strategy discussed, or invest in any specific product. Nothing contained in this podcast constitutes investment, legal, tax, or other advice, and is not to be relied on in making an investment or other decision.